Hey, good morning, everyone. Marty Mazur here, 23rd of June, 2024. Weekly roundup, I guess I'll call this. Normally, it's your economic update with a bit on the markets. Been gone, or I should say, haven't reported to you in the last couple of weeks. Took 1 week off and was back last week and provided two written commentaries for you. Today, I just want to kind of muse a bit or jump around a bit. We don't need to go through inputs to our index. We're still a negative 23, which means recession risk is too high to ignore over the next, say, 6 to 12 months. Interestingly, the one analyst or group of economists who we think highly enough of to pay quite the premium for their research, who last year was in the minority, who did not see a recession coming, actually very firmly has one on their radar late 2024 to early 2025. So that's interesting because they were out of consensus last year, very much so, and they were correct. And I would say they're out of consensus very much so this year because very few economists are actually predicting recession going forward. They are. So they're out of consensus again. Their model is telling them a very different story going forward. So I think we need to pay attention to that. Our model says simply that the risk is too high to take on significantly more risk in portfolios right here. So we'll look at some market internals. I'm going to run through some of my own notes, run through some of my own weekly exercise, just kind of thinking right here where to start. I guess we'll go with the screen that's in front of you. You've seen this before. It's the S&P 500 in white versus the S&P 500 equal weight index. The difference being the white gives emphasis to market cap, the size of the companies. The green gives equal weight across all 500 components. Of course, when the green line is descending, actually losing value, and the white line is going up, that tells you that a very small number of constituents are moving the market. That wouldn't be a sign of a healthy market. The orange is the Dow, and the blue is the 2,000 stocks that make up much of the small cap universe, which is the Russell 2000, still negative on the year. Now, I'm hearing a lot of analysts say that small caps are providing some value here that should be exploited. Folks, we will exploit small caps, but when we add, because we have virtually no exposure now, it's typically at the beginning of a new cycle where small caps tend to shine, or just prior to that, as we see things beginning to bottom. And in the economy, that's not what we see right here. So we're not adding small caps just yet. I'd love to because they look really cheap to me, but conditions just don't allow for it. So in our core index, we're falling right around in here where you see the S&P equal weight, the Dow, a little better than the Dow, right around where the equal weight is doing if you have the full complement of our core allocation. But we're only half stocks, actually call it 55% currently. So we're capturing virtually all of what the major averages are capturing, say for like the S&P and the NASDAQ, with about half the exposure. But, we've got gold and silver and other commodities, and nearly a fourth of our allocation is currently in short-term U.S. Treasuries in a U.S. Treasury money market account that's earning right around 5% still, so we don't mind sitting on some cash when we can capture that kind of yield. So clearly we are playing it very conservative to moderately right here, and not super correlated to the stock market. Folks, you've noticed days when the market's been down and we've been up and vice versa. So we think the secret to success long term is to be very diversified across asset classes and to be very diversified globally. So with globally in mind, let's take a look at some long-term histories. So what I have dialed up here, and I'm starting from January of 1970 to January of 1980. And what you're seeing here is the Europe, Australasia, and Far East Index, the S&P 500, long-term treasury bonds, gold, Bloomberg's basket of commodities and their Bloomberg Commodity Index, and the dollar. So during the decade of the 70s, foreign stocks reigned U.S. stocks were essentially flat. That's a 16% return for the entire 10-year period. So it's almost zero return. And 74% gain over 10 years is probably about a 5 or 6% annualized return. You can see bonds, although it looks like we don't have data going all the way back, made a little money. Gold looks like it did hugely the best, but that, of course, captures right in here when we left the gold standard and $35 an ounce and let gold run. So we'll just kind of disregard that one. Commodities had a really good run, and the dollar lost value by the tune of almost 30%. Now, when I move that forward and I go from 1980 to 1990, and what I'm showing you, folks, are just how these regimes tend to adjust and change. And by the way, pardon my voice. I'm getting over a pretty decent cold here. Okay, so from the 80s to the 90s, okay, now we had quite the run. We had foreign stocks gaining almost 500%. U.S. growing nicely, and here's where we can start picking up emerging markets. So we won't talk about them yet because they just got going here in terms of the data. Bonds were up 257%, so did a little better than stocks in the U.S. Gold lost 28%, commodities overall lost 33%, and the dollar gained, after being very, very volatile, gained 9% during the 80s. Okay, so how about the 90s? So the 90s saw the U.S. market go huge, right? 308%. During the 90s. Emerging markets rose 127%. For much of the period, they actually outperformed, and then with the internet and U.S. exceptionalism, if you will, back in the day, the U.S. market just ran away from everybody. Foreign developed markets only were up 70% during that time period, so very low annualized return there for foreign stocks. Bonds up 135%. Commodities down 2%, gold down again 27%, the dollar up again to the tune of 8%. And then the decade of the 2000s, 2000 to 2010. So then we had the opposite. So U.S. stocks, believe it or not, folks, lost 23% of their value. Foreign stocks were down 11%. Emerging markets about doubled. They were up about 100%. Treasury bonds were up 100%. Gold was up 280%. Commodities in general were up 50%. The dollar lost 22% of its value. By the way, folks, when you look at the analysts who do a really good job on valuations, from this vantage point, from this juncture, their 10-year projection from here for U.S. stocks is basically zero. Slightly negative to slightly positive over the next 10 years based on their study of valuations, historically speaking. While that sounds crazy to a lot of people, here's a decade right here where U.S. stocks actually lost 23% start to finish. Okay, so 2010 to 2020. And by the way, there were epic bear markets in those periods. Okay, it's not like it just was a flat line, and it won't be the next time either. It'll be with lots of volatility in between. So from 2010 to 2020, the U.S. market reigned supreme, up 185%, whereas developed markets made merely 30% and emerging markets made about 13%. Bonds, long-term treasuries are up about 100%. Gold was up 38%. Commodities in general were down 43%. The dollar was up a whopping 24%. And if we just want to extend that out to 2024, U.S. market is up 321%. Foreign stocks, 41%. Emerging market stocks are up a whopping 3%. So they're up not at all over the last 14 years. And then treasury bonds up slightly. Gold up 88%. Commodities overall down 30%. The dollar up a whopping 30%. So folks, I just showed you just on a very simple 10-year basis using calendar decades how these things tend to gyrate, how regimes change, and so forth. We've done this before. I know I've done this in great detail, focusing on the dollar. And so if you get the dollar right, you tend to get a lot of things right. Our view of the dollar going forward is yes, if we get that recession, history suggests that the dollar should strengthen as the world flies to the safety of U.S. Treasuries, bumping up the dollar. Some are making a case that this recession will be different based on interest rate differentials and so forth, and maybe that'll be the case. That remains to be seen. Our long-term view, though, notwithstanding the amount of emerging market dollar debt that a lot of people try to make a case for a stronger dollar going forward, I get that, I understand that case, but our view remains that in the next cycle, it'll be characterized by a weaker dollar, weak performance of U.S. equities, outperformance of foreign equities, and you got to know where to go. We think commodities will be special in that environment, so commodity producing nations will be important. We think gold sits very pretty right here for extended gains over a long-term period of time. We think there'll be nice yields to be had in treasuries, but there may be a limit to what total returns would be there because of what we believe is going to be a higher inflationary regime going forward. But I got to be honest with you, frankly, we are excited to a not small degree about what the next cycle has in store, because much of what we like is very, very under-owned right here. And we think as the world realizes that it's going to be time for a regime change, so to speak, in terms of asset price performance, that there will be quite the wave of capital flowing to these things that we like. However, if a recession gets in the way first, valuations on these things are going to get even more attractive. So we can't go there in size just yet, but we are poised to, as either conditions suggest that we should, or valuations get to where we think current conditions ultimately dictate they should be. And quite frankly, folks, that's, if you're talking U.S. stocks, that's quite a ways from here by any measure, if indeed recession is looming. So with regard to economic outlooks, the U.S. Economic Surprise Index done by Citigroup, you can see that's falling down to levels we haven't seen since 2022. So that means that the data is disappointing relative to what economists had been expecting. In the Eurozone, slightly negative. Europe has had some weakness here of late. We anticipated better things. We were getting that, and we've cut our European exposure that we recently added to, cut it back a little bit here recently. The French elections have kind of thrown the market into a tizzy. We don't think it's a long-term issue. We think it might be a buying opportunity, but there's enough uncertainty in that we decided just to pull back just a bit and to increase exposure to defensive U.S. stocks. Japan coming back a little bit, little less bad, but still very much in the red in terms of economic surprise. China, right near the flat line. Emerging markets as a group are actually positive, meaning that data is coming in a bit better than expected. Overall, a bit worse than expected in terms of the data, and this is global, the data relative to what economists had previously expected. Centix does a good job on sentiment, widely respected among global analysts and investors. Global conditions, current is the white line, 6 months is green. You can see it's moving positive. You can see for U.S., both rolling over a little bit, negative in terms of the 6-month outlook. Eurozone, currently negative, but positive on a 6-month outlook. Japanese conditions, both positive, but tending to roll over in terms of current and 6-month outlook. Asia ex-Japan, both positive. So, sentiment is very positive for Asia, not including Japan. And then Latin American conditions, currently negative, but positive on a 6-month outlook. We like Latin America long-term, by the way. So one thing I want to point out here, folks, and I've made this case before, is that it's not unusual to see a bounce in conditions right before recession. You can see that was happening here. And by the way, before we could spell COVID or coronavirus, we had our recession odds, very, very high leading into this, and which kept us from getting hurt in here when the market declined, 35 to 40% because we were hedged. But you can see in here, for just prior to that, like we're seeing here, we saw a nice increase in sentiment and in conditions before it rolled over. Up in here as well, you can see leading right into here just before the massive 2008 recession. In some of these areas, we were getting a little bit of a pop before we rolled over. So while many economists are saying, listen, we bottomed and we're coming out of it, they may be right, but this look is not all that unusual right before things tend to get ugly. Of course, that remains to be seen. Speaking of conditions getting good just before recession, take a look here at Peter Berezin, and he's the leader of that team who had no recession call last year and does have a recession call going forward. Just a reminder, strong growth today is no guarantee that a recession is not imminent. The U.S. economy grew by 2.5% in the fourth quarter of 2007, just as the Great Recession was beginning. So you can see right before the rough time we had in 73, 74, you can see that last quarter of the peak, GDP was 3.85%, 1980, 1.26%, 81, 4.88%, slightly positive in 90, slightly negative in 91, and here's what he was talking about in 2007. Now, 1960, it was basically beginning to roll over right before we officially got into recession. So this also makes the point that I've been making of late that we got to be careful with this notion that things are bottoming. I pointed to the fact that it looked like they are in places like Europe and so forth, but I also said I'm skeptical that if we have a U.S. recession, that the rest of the world is going to be able to hang in there. So we have to continue to be careful right here, folks. Okay, so let's just throw, and I am just jumping around, folks, so bear with me. I'm not gonna take all day, I promise. I don't think my voice would hold up. So here is from the vast end of week exercise that we go through, this part on valuations. John Hussman was incredibly prescient in terms of the degree of the decline right before the tech bubble and right before the real estate bubble. He nailed them both. He's got quite the dire move if indeed we see recession for the next bear market. He sees stocks going down like 60 to 70% based on his work. I don't sympathize. I don't think we'll see that kind of a sell-off. I think the recession will be garden variety, and I think large asset market declines will be met with massive stimulus that will probably buoy them, and I think we'll have a higher inflationary regime as a result. But I do think valuations go a lot lower than they are now, just not as low as Mr. Hussman thinks. He makes this point here that I copied this a long time ago, and he basically just asks the question, why are you taking market risk? Whether you're investing for yourself or you're a member of an investment committee making decisions for pension funds or a charitable organization, you're responsible for asking that question. The natural answer is you expect positive and adequate investment returns to compensate you for the risk. Next questions are then A, on what basis do you expect that investment return? And B, on what basis do you believe the return is adequate and proportionate to the risk you're accepting? In other words, folks, I think the way I would translate that and the way we view things are that, the stock market, the U.S. market, the things people focus on, it can do what it wants. We're going to make an overall macro assessment of the global risk-reward setup. And when the setup says add risk, add volatility, add equities, add commodities, whatever, that's exactly what we'll do. When it's ambiguous, then we will pull back, be conservative, be very diversified, be plenty liquid. When it's concerning or when it's negative, we'll do exactly what I just said, plus we will hedge at the margin the areas that we think are at the largest risk, which we think, frankly, are U.S. equities right here. So in terms of valuation, as I just kind of scroll up from here, the Shiller PE ratio. Robert Shiller won a Nobel Prize for this, and it's the cyclically adjusted price to earnings ratio. As you can see here, as at a level that it's only been twice before. Supposedly, Warren Buffett's favorite valuation indicator is simply the U.S. stock market value relative to the economy, relative to GDP. And as you can see, right here, we are at the second highest on record. First highest being right before the 2022 bear market, which peak to trough took stocks down about 30%. And our own, screens here, the price to book value ratio for the S&P 500 is at all-time highs, virtually previous all-time high, tech bubble bursting. Price to sales, second highest only to just before the 2022 bear market. And price to earnings, the highly manipulated price to earnings ratio, even with that manipulation, still really, really close to all-time high levels. So folks, from a valuation standpoint and from all these other things that I'm referencing here, could this market continue to melt higher? Of course it could. Anything can happen. Will it? It might. Is this something you should be chasing if you're managing your long-term money that's going to retire you and educate your kids and so forth? And our view, absolutely not. It's a time to be very prudent, very diversified, and we even think it's a time to be hedged. Okay, what else do I have for you here? I was going to go through more notes, but this has taken a while, so let's just jump to the technicals. S&P 500 one-year daily chart. Got your rising wedge. Folks who've been with me for years, I could put you to sleep with this stuff. But it does tend to work often in both directions. Here we were bullish. We had a falling wedge. We had bullish divergences, and look what happened. And where we've been bearish from time to time, we got some pretty good corrections, right? But no new bear markets just yet. So right here we have a classic rising wedge pattern, long divergences, overbought on the RSI. Remember back in here, I said odds favored a 5 to 15% correction. We looked at sentiment. All that is pretty much where it was, and we got about a 6% correction. I think it wouldn't be a stretch to make that call right in here, folks. So if we get some corrective action here over the next few weeks, don't be surprised. Let's just put it that way. The longer term charts, honestly, are actually bothering me a little more. Here's a 5-year weekly chart. You don't want to get overbought here with negative divergences on the weekly. And here's where we were right before that dip. We're there now. Here's where we were before we had that dip in late 2023. Here's where we were between that, call it 30% peak to trough, roughly that, in the bear market of 2022. Here we were bottoming and so forth, folks, but these aren't bottoming patterns right here. So we need to respect those while we remain open to all possibilities. Here's the NASDAQ going crazy, call it AI. Did have an engulfing candle on Thursday, engulfed Wednesday, broke down below this rising wedge pattern. Not a bearish divergence. This confirmed the rise here, but we did have the pattern. Way overbought on the RSI on the daily chart. If we do fall apart here, 449 on the Qs would make some sense, and that's a pretty good percentage decline here, and that'll get people's attention. So folks, it's, somebody can go broke shorting this market. John Maynard Keynes, back when he went broke for a while during the Great Depression, said markets can stay irrational longer than you can stay solvent. He stuck to his disciplines, came out of it just fine in the aftermath. But even the man who was considered the best economist of his day got whacked really hard trying to go against the grain of a market that was clearly irrational and exuberant. The only one that I know of, and I've studied his story extensively, was the great Jesse Livermore. He nailed the Great Depression and made tons of money before he later went broke in the market. So, folks, having done this for 40 years, I'll close with this personal story, and I'll let you get on with your day. So it was in the very late 90s, it's probably 1999, the firm I was with the whole time before we established PWA back in 2007. I was with a firm for 23 years to that point. They had their own mutual fund group, which, by the way, I didn't use, save for the first couple of years with them because of the conflict of interest. But I would listen to them and take their research in and so forth. But I believe we were in Colorado at some, fund manager retreat where we got to listen to the powers that be talk about how essentially they were abandoning their value orientation in favor of growth. So I believe, if I recall correctly, that they fired a bunch of their managers and they hired a bunch of growth managers. So essentially, the late 90s were a period of massive gains for growth stocks, let's just say technology stocks. And the value stuff was just waning. So iconic fund managers like Julian Robinson of Tiger Asset Management went out of business, and he basically, I think lost half of his assets under management because he was massively underperforming, because he just couldn't get his head around the tech. It just didn't make sense to him, these valuations and so forth. And I think he missed the top by about 6 months. He would have absolutely nailed it, but he gave up too soon. It just was so frustrating, and he was bleeding assets because people were firing him because he wasn't keeping up with the tech sector. Warren Buffett was kind of left for dead in the media. He was getting too old. He was staying away from technology because he just didn't understand it. And so I remember just tons of criticism toward Buffett because he was underperforming back then. And of course, I think when it was all said and done, he was the richest man in the world again, somewhere around the bottom of the tech bubble bursting. So my experience was, I just remember talking to someone who I worked with when we were on a shuttle after this presentation, and I just said, I think these guys are crazy. They were value managers, and it worked for a long, long time, and they're basically capitulating right now, and they're joining the crowd at a time when valuations just don't make any sense. So in my practice within that group, we were selling tech. We just had a simple strategic asset allocation strategy, which didn't allow us to get too overweight anything. So I can remember people wondering why we were dumping tech when it was going so crazy. It's just because we had too much of it. And then, by the way, we were buying it in 2003 when nobody else wanted it because we were underweight. But it allowed us not to take the massive brunt of the tech bubble bursting like a lot of other folks did. But it was just out of more luck than anything else. But I do recall, and I will say, that we've been very fortunate to not get sucked into these bubbles. At times I wish we'd stayed in them longer, of course, that's almost every time. But when they burst, folks, typically many years of gains are wiped out. We've done those illustrations before. 2008 took back 13 years of gains. I think the tech bubble took back like 5 years of gains. The COVID decline took 2, 3, maybe 4 years of gains, peak to trough. So, folks, if any of you feel like you're missing this big move that you've seen here lately in the cap-weighted averages, just know that if they tumble, you may have the opportunity to get back into at levels below where they started. And that's the situation that we hope to take advantage of if indeed we do get there. Now, it's not important to us that we get there. It's just important that conditions allow us to take on more risk when we do it, that we don't get emotional, we don't get panicky, we don't feel like we're missing out. We just stay true to our discipline and do what makes sense relative to the global risk reward setup. Folks, thank you for sticking with me that long. I hope you have a great rest of your day and week, and I'll be back soon. Take care. Bye-bye.